If you're 45, 50, even 55, the real question isn't, am I too late? It's whether your next dollar is going to its highest paying job or getting wasted in the last high-income years you've got left. Because two people the same age, same income, can end up $73,000 apart because of the order alone. Here's the exact order when you're starting late. Okay, first, let's kill the panic. Starting in your 40s or 50s is not the disaster the internet keeps telling you it is. If you've still got an income, access to tax-advantaged accounts, and 10 or 20 years of compounding ahead of you, that's everything you need, really. But here's the part nobody actually says out loud. When you start late, the order you invest in matters more. Not less, more. Think about why. A 25-year-old can throw a dollar in completely the wrong place, lose a few years, and the market quietly bails them out over the next 3 decades. You don't have 3 decades. Every dollar you put to work now is one of the last big earning dollars you'll ever deploy, and there's no 30-year runway waiting to undo a mistake. So the sequence isn't a nice-to-have, it's the whole game. And honestly, the good news is hiding right there. The rules are quietly built to help you. The tax code hands older savers bigger limits and extra room on purpose because it expects some of you to be catching up. You just have to know where to put the money. The principle is dead simple. At any moment, your next dollar has a best available job. Sometimes that job is grabbing free money from your employer. Sometimes it's killing a guaranteed loss. Sometimes it's buying a tax shelter that compounds untouched for the rest of your working life. Put your dollar in the wrong job and nothing beeps. No alarm. You just quietly earn less every month for the years you've got left. So, let me introduce you to 2 guys, Brian and David. Both 50, both earning $90,000 a year, both with $15,000 a year they can actually invest, and both sitting on a $6,000 credit card balance. Same age, same money, same starting line. Neither one picks a single hot stock. And 17 years from now, when they both retire at 67, one of them walks away with $73,000 more than the other, on nothing but the order they invested in. Watch how it happens. The first place your money goes isn't exciting. It's whatever plan at work comes with an employer match. And the reason is the single most important number in this whole video. A match is a guaranteed instant return, often 50, sometimes 100%, before your money earns a single cent in the market. Say your employer matches 50 cents on the dollar, up to 6% of your pay. On a $90,000 salary, that's up to $2,700 a year, free, just for contributing. Stop and sit with that for a second. Very few financial moves on earth beat a guaranteed 50% on day one. The stock market doesn't hand you that. Real estate doesn't. Most debt payoff doesn't either, unless you're staring down something truly extreme. Which is exactly why the match sits at the very top of the order, above everything, even ahead of crushing your credit card. Now, here's where Brian goes wrong, and it's the most expensive mistake a late starter can make. Brian's instinct is to just start investing. Open a brokerage account, finally feel like he's doing something. It feels responsible. It feels like progress. But in the rush, he skips the match completely for his first 5 years. Because grabbing the free money felt like a detail next to, getting into the market. Watch what that costs him. $2,700 a year left on the table for 5 years that he never gets back, and never gets to compound. By the time he retires, those 5 missed matches with growth are worth around $35,000. 35 grand, gone, because he was busy feeling productive while ignoring the highest return available to any investor anywhere. David does the opposite. From year 1, he puts in just enough to grab every dollar of that match. One caveat. Check your vesting schedule, which is just how long you have to stay before the matching money is truly yours. But if you're planning to stick around, take all of it, before anything else. Once you've grabbed the full match, your next dollar gets a new job, destroying high-interest debt. And here's where most videos hand you a number that's quietly wrong. One says pay off anything above 5%, another says 8%. They never tell you where those lines come from, because the honest answer is there isn't a magic number. The threshold is your own expected return. Walk through it with me. Paying off a debt is a guaranteed return equal to that debt's interest rate. Wipe out a balance charging you 22%, and you've just earned a risk-free, tax-free 22%. Investing, on the other hand, earns you a hoped-for return. A fair long-term benchmark is around 7%, and it comes with real risk and zero guarantees. So the rule writes itself. If a debt charges you more than you can realistically expect to earn investing, kill the debt first. That puts the honest line right around your expected return, not some random 5. A credit card isn't even a close call. The average card charges north of 20%. Brian's $6,000 balance at 22? That quietly costs him about $1,300 a year, just in interest. Money draining out the bottom of the bucket while he tries to fill it from the top. And this is Brian's second mistake. For those same 5 years he carries that card, minimum payments, while he keeps shoveling money into investments. His brokerage balance climbs, so he feels like he's winning, but the card's charging him 22, while his investments earn 7. He's bailing water into a bucket that's draining faster than he can fill it. If that balance stays around $6,000, that's about $6,600 over 5 years, just handed to the bank. David, he clears that card in year 1 and never looks back. A guaranteed 22%. Best trade he'll make all decade. Here's where the order surprises people. Once the high-interest debt is gone, you do not march straight back to your 401k and pile more in. You open an IRA first. Why? Control and cost. Your 401k gave you the match, the one thing you can't get anywhere else, and you've taken all of it. But some workplace plans then trap you in a short, sad menu of mediocre funds, with fees baked in that you never even see on a statement. An IRA you open yourself? You can buy the cheapest, broadest index funds out there, often for a few hundredths of a percent. Sounds tiny. Over 15 or 20 years, that fee gap alone can be worth tens of thousands of dollars. And this is where being a late starter actually works in your favor. In 2026, the IRA limit is $7,500, but if you're 50 or older, there's a catch-up that bumps it to $8,600. That catch-up isn't a participation trophy for getting older. It's the system handing you extra tax-advantaged room, exactly when you need to move fast. Inside that IRA, you hit one fork, Roth, or traditional. And the whole thing comes down to a single question. Do you want your tax break now or later? A traditional IRA may give you a deduction today, depending on your income and whether you're already covered by a plan at work. And then it taxes your withdrawals in retirement. A Roth gives you no deduction now, but qualified withdrawals can come out tax-free later. Simple rule of thumb. If you're in your peak earning years at a high tax rate right now, and a lot of people in their 50s are, that deduction today is probably worth more. If you think your rate will be higher in retirement, lean Roth. And if you genuinely don't know, splitting between the two is a perfectly smart hedge. Nothing wrong with it. Now, if, and only if, you're on a high-deductible health plan, You've got access to what might be the single most tax-efficient account in America. The Health Savings Account, the HSA. Most people treat the HSA like a checking account for doctor visits, spend it down every year. And that wastes the best deal in the entire tax code. Because the HSA is the only account that's tax-advantaged 3 separate times. Your money goes in pre-tax, lowering your taxable income today. It grows completely tax-free while it's invested. And when you pull it out for qualified medical expenses, that withdrawal is tax-free too. In, growing, and out, untaxed at every single stage. No other mainstream retirement account gives you that exact combination. Here's the move that turns it into a retirement weapon. If you can afford to pay your current medical bills out of pocket, do it, and leave the HSA invested. There's no deadline to reimburse yourself, as long as the expense happened after you opened the HSA and you keep the receipt. So you can pay for a doctor visit today, file that receipt away, let the money compound for 15 years, and pay yourself back tax-free way down the line. You've basically turned a medical account into a stealth retirement account with the best tax treatment that exists. For 2026, you can put in up to $4,400 for self-only coverage, or $8,750 for a family. And if you're 55 or older, tack on another $1,000. And think about who needs this most. You're heading straight into the years where healthcare turns into one of your biggest, most certain expenses. Building a pile of tax-free money earmarked for exactly that, that's one of the smartest things a late starter can do. It's why people who really get the HSA fund it before they even finish maxing the 401k. Now, and only now, you go back to the 401k and fill it the rest of the way up. You've grabbed the match, cleared the expensive debt, opened a cheap IRA, loaded the HSA. The higher-paying jobs are handled. So your remaining dollars come back here because it's still a seriously powerful tax-advantaged home for a big chunk of money. And this is where the late starter gets the single biggest gift in the entire tax code. One almost nobody puts on a thumbnail. In 2026, the base 401k limit is $24,500. If you're 50 or older, a catch-up brings your total to $32,500. But here's the part that should make you sit up straight. If you turn 60, 61, 62, or 63 during the year, a new rule lets you put in even more. A super catch-up that replaces the regular catch-up and takes your total limit to $35,750. That's more than $11,000 a year on top of the base limit, right there in your early 60s. Read that again. The exact years most people assume the door is slamming shut, the government swings it open wider than it's ever been. Your early 60s, the years you might be earning the most you ever will, with the house nearly paid off and the kids gone. They're literally designed to be your single biggest acceleration window. If you're starting late, this is the rule you build your whole final decade around. Most people in their early 60s have never even heard of it, so just knowing it exists already puts you ahead of them. One quick note, if you're a high earner, starting in 2026, if your prior year wages with the employer sponsoring the plan were over $150,000, your catch-up contributions may have to go into Roth instead of pre-tax. Still allowed, just taxed up front. And remember, a dollar you send into a traditional 401k is a dollar the government doesn't tax this year. So part of every contribution is basically funded by tax you'd have handed over anyway. For someone in their peak earning years, that's one of the biggest deductions the tax code offers. It sits here, not earlier, only because every step above it pays even more per dollar. When every tax-advantaged account is full, match grabbed, debt gone, IRA maxed, HSA maxed, 401k maxed, Then, finally, you open a regular taxable brokerage account. This is the account most people want to start with, and it belongs last. The reason is tax drag. In every account above this one, your money compounds untouched. In a taxable account, the tax collector takes a little bite along the way, on your dividends every year and on your gains when you sell. Small leak, but it runs for as long as you hold. And this is Brian's last mistake. For those first 5 years, while every higher-paying account sat empty and the match went unclaimed, he was funneling money straight into a taxable account. It felt like investing. The account was real, the stocks were real. But he was paying the tax collector for the privilege of skipping the free money and the shelters first. The taxable account does have one real superpower, though: total flexibility. No contribution limits, no early withdrawal penalties. If you want to retire before you can touch your retirement accounts, this is the bridge that gets you there. So it earns its spot. It just earns it last. And when you get here, keep it boring. Broad market index funds, not picking individual stocks. Even most professionals lose that game. That's the core order. What's left is optional, personal. Low interest debt and the mortgage. If you've still got debt below your expected return, a cheap car loan, a low-rate student loan, a 3% mortgage, the math says you'll probably come out ahead investing instead of rushing to pay it off. Your expected return just beats the interest rate. But this is the one place where the math isn't the whole story. Some people sleep better with no mortgage payment and zero debt to their name. And that peace of mind is real. No spreadsheet captures it. Just make that call knowing it's a lifestyle choice, not the optimal financial one. And make it after the steps above, not instead of them. Because the same logic that trapped Brian applies right here. Rushing to wipe out cheap, low-rate debt feels responsible. But if it jumps the line ahead of free money and guaranteed returns, it quietly costs you. Most of all, in the years you can least afford to waste. So let's run the tape. Same age, 50. Same $90,000 salary. Same $15,000 a year to invest. Same 7% market. The only difference between Brian and David is the order they put their dollars to work. David, match first, then the credit card, then the IRA, the HSA, a maxed 401k, and a taxable account dead last. Retires at 67 with about $528,000. Ryan spent just his first 5 years in the wrong order. Skipped the match, carried the card, poured everything into taxable. Then he woke up and fixed it. 5 years. He ends up with about $455,000. That's $73,000 gone for 5 years of wrong order, on the exact same income and the exact same investments. About $35,000 of that is just the match he walked past. A few thousand more is the credit card interest he bled. And the rest is the quiet tax drag of feeding a taxable account while the shelters sat wide open. And if Brian never fixes it, if he just keeps doing what feels responsible year after year, the gap climbs to nearly $150,000. Same salary, same market, same effort, just a worse order repeated for 17 years. That's the whole point. You don't need to pick the next hot stock. You don't need to time the market. You just need to put each dollar in its highest paying job in order. Grab the match, kill the high-interest debt, fund the IRA, load the HSA, max the 401k, and lean on those catch-up limits hard. Then, and only then, the taxable account. Boring? Maybe. But boring, done in the right order when you're starting late, That's exactly what quietly beats almost everyone out there chasing something exciting. So, if you're behind, you're not out of the game. You're just at the part where the order finally matters. Get the sequence right for the next 10 or 20 years, and you don't just barely catch up. You build real wealth. If this gave you a clearer picture of where your next dollar actually belongs, do me a favor and subscribe. It genuinely helps this reach more people who think it's too late when it really isn't. And if you want to go deeper on the catch-up and super catch-up rules, and exactly how to sequence your final decade, I'll see you in the next one.